Yes. Good evening, friends. Welcome you all on this virtual platform today. It's a great pleasure to have all of you again, once again on this platform. Friends, today the topic that we have is income from house property. And before we start this session, our speaker is joining the session because of some technical hitch. He is being joining within a few minutes. Before we start this session, I would like to inform that our CCM CA Chandrasekhar Chitre sir, who is the chairman of Direct Tax Committee, has informed me to apologize on his behalf to all of you that he could not join because of some unavoidable circumstances. But anyway, if he finds time in between, he will surely join us. But then he has conveyed the apologies to all of you. With this, I would like to now welcome first CA Dr. Raj Chawla sir on this virtual platform. Welcome to you, sir. And I would like to hand it over in the hands of Chawla sir to give his welcome address here. Over to you, sir.
Thank you, Kale sir. Good evening to all. First of all, I welcome all the participants to this webinar, and I am thankful to my chairman, CA Chandrasekhar Chitale, Direct Tax Committee, and I'm also welcome CA Chandrakant Kaleji and CA Sachin Derangeji, our coordinator of this program, and I also welcome my colleague, Mr. Kotha. He will speak on income from house property. And as we all know that income from house property is a very important uh, chapter in our Income Tax Act. So today Kotha sir will explain all the nitty-gritty on this subject. So with this, now I request Mr. Kale to please take this webinar forward.
Yes, sir. Thank you, sir, for your uh, uh, visible words given to us. Friends, we know that everybody wants to own a house once in his lifetime, and this he wants to achieve someday or the other. And he all during his lifetime he feels that he should own a house by the time he is leaving this world. But then when we own a house, there are a lot of responsibilities to be taken up. Firstly, that we start off with paying property taxes, then we think of taking up a loans or not, and even if we are availing the loan, then how we will be saving tax on the interest on house property that we are paying to the financial institution or to the banks. Further, we also would like to do planning when it comes to ATC deductions, because again principal is again the part where we can get the deduction under section 80C. So that planning is also required. Then we come to the calculations of basic house property, and then we come to the filing of ITRs, appropriate ITRs. Now, when we talk of house property, it includes everything, whether it is an office or whether it is an office shop, building, or land attached to the building, which sir is going to explain us in more in detail. Income tax doesn't make any differences whether it is a residential property or a commercial property. But there are various issues that today our speaker will be highlighting, and we will see how he is going to talk to us on this particular subject. Friends, when we talk about section 22, it derives the annual value of the house property. But then it doesn't matters whether the what amount the tenant is paying. It is immaterial. Secondly, if the income is received from renting of land or open spaces, it is not taken under income from house property, but then it is taken under income from other sources. Again, when we are renting out the house property, and if it has been subletted by the tenant, again the rent owned by the tenant is again not been taken as a house property, but it is taken as income from other sources. Then there are some hitches also. When a partner is giving the his own premises on rent, and in the partnership firm, but if the partnership firm is paying the rent to the partner, then of course it is been taken as income from house property. But it doesn't, then it is a question mark, which okay, what is to be done. whether a notional income is to be taken or not, or whether it is taxable or not. So these are some the issues. Then again, very much big one more issue is there. As far as Section 22 is concerned, income from house property is always taxed to the owner, who is the owner of the house property. But there is a Supreme Court case where CIT versus Poddar Cements Limited, it says that the person who receives the right to receive the rent will be taxed under the income from house property. So sale deed, where we say that the sale deed is a very important document where it denotes that he becomes the owner of the property, is been not required as far as the this case is concerned. In case of joint holders also, if the share is determinate, yes, it is been divided between the two. But when the shares are not determinate, then it is taxed as AOP. So various issues are there, and I hope that today we have been joined by Kotha S. Srinivas sir. Sir, you joined us a little late. We are sorry, but already Chawla sir has made a welcome address, and we again welcome you back on this virtual platform. Welcome to you, sir. You were not there, sir, when I spoke that ki CA, our Chitre sir has.
No. There, my video was not there. I heard both from the beginning. I'm there.
Yes, sir. So, okay.
Only video was
Now, without wasting our time, I think we have crossed around 10-15 minutes more. Before I hand over the session to you, I would like to request CA Sachin Dirange, who is the Managing Committee member of the Pimpri Chinchwad branch, which is in Pune, I would like to hand over into his hands to introduce the today's speaker. Over to you, Sachin.
Thank you, Kali sir. Thank you, Chawla sir, for giving me this golden opportunity to introduce such expertise person, J. Kotha Srinivasan sir. He is a BCom graduate from Bangalore University and a fellow member of Institute of Chartered Accountants of India. And he is also a member of Institute of Cost and Management Accountants of India. He is a partner of SSB Associate Chartered Accountants, Bangalore. Kotha Srinivasan sir, he has served Institute for over 2 decades, 2.5 years as a student committee member of Tikasa, Bangalore branch. 9 years, he was a managing committee member of a Bangalore branch of SIRC of ICI. And 9 members as the regional council member of SIRC of ICI. As a student committee member, he has served as a member and secretary of Students Association. Say Kotha sir, during his tenure at Bangalore branch of SIRC of ICI, he has served all the positions. He was the chairman of Bangalore branch during 2009-2010. During his chairmanship, he started distributing backpacks back to CA students, and so far over 25,000 students have been benefited by this initiative. During this year, the branch was adjudged the best branch of SIRC. As a regional council member, he has served from 2010 to 2019. He was the chairman of SIRC during year 2017 and 18. C.S. Kotha Srinivasan sir, as a member of SIRC, has brought in many initiatives, which includes conducting ARRC, Annual Regional Residential Course on Indirect Taxation, and is successfully conducting 5 AIRC International Taxation. He organized regional level interstate cricket tournaments for the members. He was instrumental in collecting around 70 receipts. He conducted around 1,000 hours CPE programs at SIRC during 2017, first of its kind. Organized 5 AIRCs during year 2017 in southern region, covering GST, international taxation, Ind AS and corporate laws. He prepared concept paper for coaching classes as a chairman of academy advisory groups. He was instrumental in developing digital project of SIRC. The Kotha sir improvised IVR system for members and students is made available in 6 languages. Infrastructure development at SIRC was undertaken. Presented papers at various study circles, meetings, workshops, seminars and conferences on topic covering direct tax and indirect international taxation. Visiting faculty at ICI Bangalore, a book named CA Referencer for Chartered Accountants, which was released by Bangalore branch of ICI as a study circle series booklet. Life member of Karnataka State Chartered Accountants of Association, life member of Bombay Chartered Accountants Society, founder of a group Dynamics, a study group on international taxation at Bangalore and Chennai. His contribution to PIHG group created professional information sharing group for the benefit of members. Kota sir also have contributed in CARES group, created CARES group to help members at the time of pandemic. Oxygen concentrators was a part of the team for collecting oxygen, collecting and donation for the members for purchasing oxygen concentrators for the use of members and others during the COVID pandemic. Yoga for members. Kota sir has organized various yoga classes for the benefits of the members and their families during lockdown to maintain their immunity and mental health. He has a wide range of experience and he contributed a lot for the profession and the society. He is fondly known for think differently, act perfectly.
Yeah.
Thanks.
Thank you, Sachin, for giving a very wonderful introduction of today. I now hand over this session into the hands of Kota sir. Over to you, sir. It's your time now.
Thank you, Sachin Dirange for introducing me. And also I thank C. Chandrakant Kale, the other coordinator of this particular program. We have with us the Vice Chairman of Direct Tax Committee, Dr. Raj Chala from Delhi, who is there, gave his opening remarks. And also in absentia, let me thank Chandrakant Sir Chittale, the chairman, maybe due to his other engagements, he couldn't join. First of all, let me thank DTC and the chairman and vice chairman for giving me this opportunity. In fact, I am also part of this DTC committee, DTC, where I am a member of this committee. When Chittala sir asked me to make a presentation, he asked me to select the topics, and I selected this house property. I said house property and capital gains. He said you can take up house property. As Chandrakant sir was telling, this is one of the small heads of income. You know, there are 5 heads of income. One of the small heads of income is income from house property. Of course, it's not that we don't have issues and income from house property, but it is limited. So if, we cannot say that there are a lot of issues under income from house property. There it's limited issues, and it's a very simple topic, and all of us are aware of this income from house property. It's not that I'm sitting here and I'm giving you something which none of us are aware. So it's only brushing up of our memories, like because day in and day out we may not talk about income from house property, because we'll be doing more on business or profession, or we may be doing more on capital gains. But income from house property, it's not one thing which regularly we do. Maybe during the time of computations and all, we take it up. Anytime when we get some peculiar situations, then only we'll get into more details as such. So considering all those things, I'll just take you through some of the provisions of income from house property. I know it's all basic provisions. It's only taking you to the provisions of income from house property. And finally, we have certain issues. So some of the issues we'll try to discuss at the end of the presentation. And if we cannot discuss more issues, no problem. You can just write it to us so that we can answer those. We can take up those issues. Can I share the screen? I'll share the screen, sir.
Yeah.
Okay. Okay, no, sir. Screen is visible, sir.
Yes, sir.
Okay. Okay. So as I said, we are talking about income from house property.
Hello.
One second. I'm not able to do this slideshow. Why it is not coming? Today we are discussing about income. Sir, is it clear now?
Yeah, is it
Hello.
clear? It is clear,
Oh,
sir.
okay. Okay.
But
Okay.
it has to be full screen.
Yeah. Yeah. Is it okay now? Okay. So today we are discussing income from house property. These are all some of the topics for today's discussion. I've just listed out. One is the chargeability of the income from house property. Then some of the exempted property income. Then we take you through the computation of income. Then some of the other provisions. Then a little bit on set off and carry forward of losses, deductions under Chapter 6A, then TDS provisions, and finally, time permitting, we will go for the issues. As Mr. Chandrakant Kale said, yes, definitely every person would like to have his own house property during his lifetime. And after getting that house property, we know like a lot of pain has to be taken to get a house property. And after getting that particular house property, there may be, we have to think about the taxability of that particular thing. And to purchase a particular house property or construct a house property, there will be a lot of things like he may have his own funds or he may have to borrow funds. So when once he borrow that particular funds, whether the interest paid, whether allowability of that, we have to see. If it is let out, what should be the chargeability of that? If it is self-occupied, what is the chargeability? So all those things one has to look into. So if I take you through the sections, we have only 6 sections. That is some section 22 to section 22 to section 27. Only 6 sections are there. Section 22 talks about the charging section. Usually for the first section of every head of income will be charging section, and the other sections are the section 23 which talks about annual value. Then we have section 24 which talks about the deductions. Then these are some of the small sections. Section 25 inadmissible expenses, section 26 ownership, and section 27 as deemed owner. So let us try to understand some of the concepts of these sections. Section 22 charging section says the annual value of any property consisting of building or land appertainant thereto owned by the assessee in the previous year is charged to tax under the head income from house property. And there is one exception to in section 22 itself. If the particular property is held by the assessee for the purpose of his own business or profession, the income of which is chargeable to tax under the head income from business or profession, then that will be excluded. So if you see the limbs of charging section, it is the annual value of house property, it says. So what is house property? Whether house property is defined under the Income Tax Act? The answer is no. The Income Tax Act doesn't define house property. Of course, somewhere it defines property under section 56(2), which includes movable and immovable property. But when it comes to charging of income or determining the annual value for computing income under the head income from house property, we talk about only immovable properties. So property consisting of buildings or lands apportioning thereto. So what is this building, whether it is a residential building or commercial building? Of course, the head of income is income from house property. Whether we should construe that it is only houses that is chargeable to tax under the income from house property, the answer is no. The heading name is income from house property, but it is not just the house property that will be the dwelling units, what we call, is subject to tax. Even the commercial properties are also coming to be taxed under the head income from house property. And it says buildings and lands apportioned thereto. What do we understand by the word buildings and lands apportioned thereto? Buildings and lands apportioned thereto means whatever the land that has been connected with the building. Say suppose if you take a plot of land, say suppose you take a plot of land of 4,000 square feet or 5,000 square feet, let us take. There is a construction of a portion in that particular 5,000 square feet plot. There is a construction to the extent of say 3,000. Then the balance 2,000 is left as it is. It may be for gardening, it is for a garage or a parking, whatever as a landscape you would have left. It's everything is in that particular plot itself. So when once we talk about a building, we say building or lands apportioned thereto. So which is attached to that particular building or which is part of that particular plot is considered as buildings and lands apportioned thereto. The same example what I am saying, there are two plots. One is next to each other. So one plot is 5,000 square feet, where in that we would have constructed a portion of that is say 3,000 square feet of building is there, and balance 2,000 is kept as landscape or vacant. And there is one more plot next to that, another 5,000 square feet property is there, but there is no building in that. So when once there is no building, can we say, since it belongs to the same assessee, whether we can take both as lands apportioned thereto? The answer is no, because at a particular plot we should consider, so that when once you have a different plots, so this is one plot, next one is a separate plot, and if you have earning any rental income on that particular vacant land, that should be charged to tax under income from other sources and not under income from house property. So whenever we have to charge something under the head income from house property, as the charging section says, the annual value of property consisting of buildings or lands apportioned thereto, owned by the assessee in the previous year, is subject to tax under the head income from house property. There is one exception, as I said, if that particular property is held by the assessee, whoever is the assessee, for the purpose of his own business or profession, then we need not calculate the annual value. When we talk about a building, so there may be various units in a particular building as such. So it is not that entire building is construed as one unit. Suppose there is an apartment in a particular plot of land where we have some 20 apartments, assume. So each unit is considered as separate unit. So when once we calculate income from house property, everything has to be, if it has got 20 dwelling units, or say suppose out of that 20 units, 15 units are for residential purpose and 5 units for commercial purpose, total 20 units. So when once we calculate house property, every unit is considered as a separate thing, and we will calculate consolidated income from house property on all those units as such. In the example, I said 15 units are for residential and 5 units for commercial. Maybe the assessee would have rented out, say out of 15, you would have rented out 13. 2, he would have kept it for self occupation or self residence. And out of 5 commercial plots, assume that 3 is using for his own purpose and 2 he has let out. So whatever he is using for his own business or profession, that need not be on that. We need not calculate annual value. So whichever units that has been let out or rented on lease, so on those units we have to calculate the income, that is annual value of a particular property as such. So charging section deals with what is subject to taxation, as I said, buildings and lands apportioned thereto. The next section talks about annual value. Section 23 talks about annual value. How to determine the annual value as such. Even Chandrakant sir, hello.
Sir.
Sachin or Chandrakant, anyone
Yeah,
of you? Yeah. Sir, first I will just go through this slide and then go to the other slides. Is it okay, or you want me to take slide wise?
It's
Hello?
okay, sir. It's up to you, sir.
Okay. No. Now is it okay now? Like, is it
Yeah,
clear?
it's okay. Quite visible.
Okay. No. The explanation is okay, na? It's going on.
Yes, sir. Yeah, sir.
Okay.
Perfectly okay.
Then section 23 talks about annual value. To determine the annual value of a particular. Hello? Yeah. Is it okay now? Hello? Huh? Hello? No, you're not, it's not visible, huh? Now?
It is.
No, I have not moved. It is only there. That's what I asked. I will move that afterwards. So I am here on. No. That's what I spoke to Chandrakant. So I will move afterwards. It's not moving. I have kept it and I'm just explaining. Sachin, no? Okay. So we are talking about the next section that which deals with annual value. So we have to determine the annual value of the property that needs to be charged to tax under the head income from house property. For determining the annual value, let us classify or bifurcate the house property into 4 divisions. So something called let out property, LOP, what we call let out property. Then we have self-occupied property, SOP. Then we have deemed to be self-occupied property, DSOP, and then we have something called DLOP, that is deemed to be let out property. So annual value has to be determined with respect to each and every type of house property as such. So here earlier maybe there was something called partial what do you call this, self-occupation and partial let out. Say in a period of 12 months in the previous year, 6 months a person would have kept a particular house property on as a self-occupied property, and the balance 6 months you would have let it out on rent. So there proportionately earlier we used to do. Now that particular concept is not there. So even one day, if a particular house property is let out during the previous year, it is considered as let out property. Even if a assessee owning a house property which is self-occupied by him up to 30th of March and 31st March he will let out that particular property, then there is no question of bifurcating that particular calculation for 364 days and 1 day. So entire 365 days has to be taken as let out property. If a person will be eligible to claim a particular house as a self-occupied property only and only if the property or part of that particular property is not let out during whole or any part of the previous year. So the entire previous year, that is from 1st of April to 31st of March, that particular property should not have been let out. So then only that particular property will be eligible or can be treated as self-occupied property. So I said there are 4 classifications: let out property, self-occupied property, deemed to be self-occupied property, and deemed to be let out property. So for each and every type of property, we have to see how to calculate the annual value. So for self-occupied property and deemed to be self-occupied property, the annual value will always be nil. So that we have to understand that annual value for self-occupied property and deemed to be self-occupied property will always be nil. With respect to let out property and deemed to be let out property, we have to calculate the annual value as per section 23 subsection 1. So 23 has got 5 subsections: 1, 2, 3, 4, 5. 23.1 deals with calculating annual value with respect to let out property. 23.2 deals with the meaning of self-occupied property and the deemed to be self-occupied property. 23.3 gives us the conditions where a particular residential house property is treated as self-occupied property or deemed to be self-occupied property. 23 subsection 4 deals with a situation where a particular property is considered as deemed to be let out property, and 23 subsection 5 talks about a person assessee holding a property as stock in trade. So we will see all those things in the next slides as such. Then we have section 24, which talks about deductions. So deductions, we have 2 deductions under section 24. Maybe the students who write the exams now are fortunate to have only 2 deductions, because when we all were writing the exams, maybe when we started in 91, at that time we had some 10 deductions. Now it's only restricted to 2 deductions, 24A and 24B. 24A talks about a standard deduction at the rate of 30% of net annual value. So before getting into the deduction, if I have to give you the structure of computation of income from house property, the first line will be the gross annual value. From that, we have to deduct whatever the amount that has been paid towards the municipal taxes. So municipal taxes will be collected by the respective state governments for the house property every year. So whatever the annual value or municipal taxes charged by the local authority has to be claimed as a deductions, can be claimed as a deductions on payment basis only. The net result will be the net annual value. From that we get two deductions, that is 24 subclause A and 24 subclause B. 24 subclause A talks about 30 standard deduction of 30% of NAV, that is net annual value. So 30% of net annual value will get a deduction. 24 subsection B talks about interest paid on housing loan. So if an assessee has borrowed a particular amount towards construction or acquisition of a property or repairs or renewals of the property, then whatever interest paid on the capital borrowed will be allowed as a deduction under section 24 subsection B. From that, whatever the resultant figure is there will be either income from house property or loss from house property. When I said in case of self-occupied property and deemed to be self-occupied property, always the annual value is nil. So there is no question of computing annual value in case of self-occupied property and deemed to be self-occupied property. But we have to apply all the provisions to decide whether this particular house property is self-occupied or deemed to be self-occupied. When once you determine that, then annual value is nil. Even for self-occupied property or deemed to be self-occupied property, one has to pay the municipal taxes. So whenever you have paid the municipal taxes, since annual value is nil, we cannot claim that municipal taxes. So it cannot be 0 minus whatever you have paid, it cannot come as negative. So net annual value will always be 0, that is nil. So when once net annual value is 0, if you put 30% a standard deduction under section 24A, that also will be 0. Only deduction that you can claim in respect to self-occupied property and deemed to be self-occupied property is interest paid on housing loan. That is, if the assessee would have borrowed some funds for the construction of a house property or acquisition of a property, any interest paid on that borrowed funds, that will be allowed as a deduction under section 24 subsection B. And always one thing we should remember in case of self-occupied property and deemed to be self-occupied property, wherever the interest is paid and if you claim the deductions, always it will be loss from house property. There cannot be income from house property in case of self-occupied property and deemed to be self-occupied property. So either it can be loss or it can be nil. So there is no question of profit in case of self-occupied and deemed to be self-occupied properties. So these are the two deductions available under section 24. Then section 25, we have inadmissible expenses. So I was talking about assessee who makes a payment towards interest, he will be eligible to claim that particular interest payment as deduction under section 24 subsection B. Section 25 says if the recipient, the person who has given the loan, who is a recipient, is a non-resident and interest is paid to a non-resident. If it is to a resident, no problem. If it is interest is paid to a non-resident, we cannot claim deduction until and unless the required TDS has been deducted under section 195. So if there is any payment of interest made to what you call this, a non-resident, the recipient, the owner is a non-resident, or no, sorry, not the owner, the lender is a non-resident, and interest is payable to the non-resident without deduction of TDS under section 195, then you will not get deduction under section 24 subsection B. There is one more section called section 25 capital A, which talks about unrealized rent and arrears of rent. So I will, once we go to the annual value, I will talk about unrealized rent. So there is something called arrears of rent. And one thing in income from house property, it is chargeable to tax on accrual basis. It's not on cash basis. So whether rent received or receivable is subject to taxation. So there may be a situation where something called arrears of rent is there. So there may be a discussion with the owner and the tenant for some increase in the rent. Maybe there may be negotiation that is happening which it has not been accepted by the tenant in the initial stages. So whatever rent received or receivable for a particular financial year, we will take it for calculating the annual value. But subsequently, because after negotiation, the tenant may say, okay, we will pay you the arrears of rent, and we will pay from last 1 year or 2 years, wherever the discussion has started. So that arrears of rent would have been received in the current year, the previous financial year, whatever we see. So that has to be charged to tax under income from house property. So whenever an assessee receives arrears of rent, or you say this unrealized in a particular financial year, that will be subject to tax in the assessment year. From that, they can claim that standard deduction of 30% on net annual value. Then section 26 talks about ownership. So we know that this is practically there where if a person individual would like to buy a property, he would like to add his spouse also, the name of his spouse. So that will be considered as ownership property. So wherever there are two or more persons, individuals who is joining together to buy a particular property, then it is considered as a co-ownership property under section 26. In case of co-ownership property, where you can determine the share of each and every individual. Suppose I gave an example of husband and wife. If you can determine their share, the husband is 50% or wife is 50%, or it may be husband 70% and wife 30%, something like that. If you have, you can determine the share, and it has been specifically mentioned in the deed or the registered deed when you make a purchase, then both are considered as individual owners, and whatever the income that arises from the house property up to net annual value will be calculated, and that will be divided proportionately. Suppose example I said husband is 70%, wife is 30%. Then we calculate the net annual value, and assuming that it is a self-occupied property, or even if it is a let out property or self-occupied property, whatever may be the nature of that particular property, we calculate net annual value, proportionately we divide, and then the deductions will be claimed independently. So when you can determine the share of each and every co-owner, then it will be computed in their individual names. So by dividing that particular thing, and they can claim the deductions under section 24 A and B, that is 30% of annual value, and also interest portion that they have paid for that particular property, they can claim under section 24 subsection B. If suppose we cannot determine, I'm not talking about the situation of only husband and wife. It may be a group of individuals who come together and they may purchase a property. In those cases where the shares are not determinable, so it is we cannot determine, then it can be considered, it will be assessed as an association of persons. But usually what happens in a group of persons coming together, they will their shares will be determinate, but they cannot claim individually, because it will be assessed as an association of persons, and whatever the rent they get, TDS also will be there. So that practically it will be difficult for them to take TDS credit to individual owners as such, but the TDS credit has to be taken in the associated persons. Whenever refund comes, that has to be distributed to all the co-owners. So whenever the shares can be determined, we can determine the shares of each and every co-owner.
Hello.
Hello.
Sir, sorry to interrupt. Hello, Kota sir.
Tell me, sir. Hello. Hello.
Kota sir, actually PPT is not moving.
No, I am not moving, sir. I will move that.
Sir,
5 minutes.
PPT move नहीं कर रही है actually.
नहीं वो सब. Hello. Just 1 minute. Just give me 2-3 minutes, sir. I will move that. I'm in the last section. I will move everything. Please. Hello. Yeah. The next, the last section in this particular thing is deemed owner. Section 27 talks about deemed owner, where there are various situations. Even though the assessee is not the owner of that particular property, because the charging section says he should be the owner of the property. There are certain situations where he may not be the owner of the property, but still is considered as the deemed owner. So when he'll be considered the owner of the property, there may be various circumstances, or if you take practically, the title of a particular property will be transferred to the another person on the date of completion of the registration of that particular sale deed as such. So there are certain circumstances where he may not be the owner, but he is considered as the deemed owner. So because deeming provisions is also there in this particular under the head income from house property, as we say that even deemed income is also charged to tax under the head income from house property as per section 22. So there are a lot of deeming provisions that is there in entire income from house property as such. So let me start moving this. So I just wanted to give one bird's eye view of all the sections. Then now I thought we will go into each and every section as such. So now is moving now, sir. Hello, is it visible now? Section 22 talks about chargeability of annual value, as I already explained. So rental income is taxable under the head income. It's not moved, huh?
No.
Hello?
No, it is-
Okay, sir, 1 second, sir. Just 1 minute, sir. 1 minute. I'll stop sharing and then start sharing, sir. So I thought I was in the third slide. Sorry. 1 second. Is it visible, sir, now? What is that there on the heading?
Section 22.
Okay, sir. Okay.
Chargeability of annual value.
Okay, sir. Actually, I was in this particular slide, sir. Was it visible to you? Hello?
Yes, sir.
Previously, I was in this slide. Was this visible? No.
No, this was not visible.
Oh, it was here only, huh? Sorry, sir.
It was here only. Yeah.
Okay, sorry. Okay, just 2 minutes. I will take you to that slide, sir. Just give me 2 minutes. Well, members, actually, I said that. So these are the topics for today's discussion. I said that is chargeability, exempted property income, computation of income, and other provisions. Then we will go through the set off and carry forward of losses. Then deductions under Chapter 6A. The TDS provisions, and finally time permits. We will take few of the issues. So I was in this particular slide and I was discussing. I didn't know that it was not visible. This is the 6 sections which I explained. That is section 22, charging section, section 23, the annual value, section 24, the deductions, section 25, inadmissible expenses, section 26, ownership, section 27, deemed owner. So this is what I was explaining from past 10 to 15 minutes. This was the slide. Now we'll move on to, sir, is this visible, sir? Section 22?
Yes, sir. Yes,
Okay,
sir.
okay, sir, okay. So section 22, as I said already, chargeability of annual value. So the rental income is taxable under the head income from house property following 3 conditions as satisfied. That also I've explained. So property consists of any buildings or land apportioning thereto. Then the assessee should be the owner of the property, and finally, the property should not be used by the owner for the purpose of any business or profession carried on by him, the profits of which are chargeable to income tax. So this I explained earlier also. Maybe once again I can tell you that the 3 limbs. Property means it's consisting of buildings or land apportioned thereto, and the assessee should be the owner of the property, and that particular property should not be used by the assessee for the purpose of any business or profession carried on by him. If he is carrying on a business or profession in that particular property, then that particular portion will not be considered for arriving at the chargeability or annual value, which is subject to taxation. So any portion of the building or any property used by the assessee for his own business or profession is not subject to tax under the head income from house property. Then assessee must be the owner of the property. It says like owner is the person who is entitled to receive income from the property in his own right. In fact, in the opening remarks, Chandrakant Kale sir also was talking about a person who is entitled to receive income from the property in his own right. So he should have a right to receive the income. So not just a legal owner, but he should have that particular right to receive the rent from a particular property, then he will be considered as the owner. When we see some of the situations of deemed ownership, we will understand that he may not be the owner of the property, but he has got a right to receive the rents. So then a person, he should have a right to receive the rent. Then he only will be considered as the owner of the property. And the requirement of registration of the sale deed is not warranted. It's not that always all the situations the registration is necessary. There may be situations where the property is not transferred or registered, but all the other activities have been completed, but still the person who is holding that particular property or who has got a right to receive the income from that property will be considered as the owner of the property. Ownership includes both freehold and leasehold rights. So the owner of the land, it's not that he should, there are two things. One is land and the other one is building. So there may be a situation where one particular assessee may be the owner of the land, the other person may be the owner of the building. It is not that always the landowner should be the building owner also. So in case of leasehold rights, he may not have he may not be the owner of the land on which the building is constructed, but he may be the owner of the building and he will be charged to tax under the head income from house property. He has got a right to receive the rent from that particular building. Ownership includes deemed ownership, as I explained. Let me go to that deemed ownership when it comes. I will explain what are all the situations where a person or an assessee is considered as a deemed owner. The person who owns the building need not also be the owner of the land upon which it stands, which I explained. The assessee must be the owner of the house property during the previous year. So we know that income earned in the previous year is subject to tax in the assessment year. So the assessee should be the owner in the previous year. In the assessment year, he may or may not be the owner of that particular property. So assume that on 31st of March, a property which was let out during the previous year was sold or transferred. So from 1st of April, he may not be the owner, but for the previous year, he has earned the income. So that should be subject to taxation in the assessment year. During the assessment year, he may not be the owner, but whatever the income he has earned in the previous year as a owner of a property is subject to tax under that income from house property. If there is any dispute in the court of law between two persons, who is the owner of that particular property, then how it has to be, who has to file the income tax returns, the decision as to who will be the owner chargeable to income tax under section 22 will be of the income tax department till the court gives its decision to the suit filed in respect of such property. So income tax will determine who should be the owner, maybe based on certain previous years instances, what are the things that they have on hand. Based on that documentation, they may say either A or B should be the owner of a particular property till that particular dispute is resolved in the court of law. Now I said there are certain property incomes exempt from tax. So let us see under section 10, which are all the properties which are exempt from chargeable to tax under the income from house property. One is income from farmhouse, which is exclusively used for or part of this agriculture income is exempted. Then we have annual value of any one palace of an ex-ruler. So we have rulers in India. We know there are a lot of rulers earlier, maybe after the Constitution of India, and when once we have all these states in place. So we have these ex-rulers may have various palaces. So under section 10, subsection 19A, one palace of an ex-ruler, the annual value of that will be exempted from taxable under income from house property. Subsequent palaces will be subject to taxation. Then section 1020, property income of a local authority. Then we have property income of an approved scientific research association. So under section 35, we have approved scientific research association. And if they have a property and any income that has been received by this scientific research association, that will be exempted under section 1021. Then we have section 1023C, which talks about various exemptions that has been given. So with respect to funds, trusts or institutions, which are into the form of hospitals or other medical institutions, universities or other education institutions, where their income itself is exempted. And if they own a house property, that is also exempted under section 1023C. Then there is section 1024, which talks about property income from a trade union, and section 11 talks about house property held for charitable purpose. We know that in case of trust, the property held under trust, when we talk about property held under trust, any income that has been received from that particular trust, which is doing the charitable activities, that will be exempted subject to other conditions of section 11, 12 and all. Section 13A, which talks about property income of a political party. If a political party is having a property, any income from that particular property is exempted under section 13A. Then section 22, the charging section itself, as we have already understood, property used for own business or profession by the assessee. So in the charging section itself, we have one exception where the assessee is using that particular property for his own business or profession, then that will be exempted under section 22. Then we have section 23 4A, two self-occupied properties by the assessee. So when once assessee has got two self-occupied properties or properties that has been discussed under section 23 subsection 2, that is self-occupied property or deemed to be self-occupied property, two properties will be exempted. Beyond two, that is if an assessee is having four house properties which is self-occupied or deemed to be self-occupied, then at the option of the assessee, two will be exempted. The remaining two will be subject to tax, or it will be considered as deemed to be let out property, and valuation of that gross annual value will be determined as per section 23 subsection 1. So these are some of the cases where property income is exempt from tax. Then we will talk about deemed owner. Section 27 talks about deemed owner. So there are 4 or 5 situations where a person, an assessee, is considered as a deemed owner. So in this case, an individual is considered as deemed owner, where individual in case of transfer of property for inadequate consideration too. So if an individual is transferring his house property for inadequate consideration, to whom? If the transfer of property, house property, is to spouse, or if the transfer of house property is to minor child. So in case of an individual is considered as a deemed owner in case he transfers house property for inadequate consideration to either spouse or minor child. Transfer of house property to spouse or minor child. So what is this inadequate consideration? Say suppose the value of a property, either it may be a market value or since we don't have the market value in these situations, let us take a stamp duty value. Say suppose the stamp duty value of a particular property is 50 lakhs and an individual is transferring that particular property to the spouse for inadequate consideration or no consideration. So instead of 50 lakhs, he may take only 20 lakhs and he is transferring that particular property to minor child as with zero consideration. In those cases, even though the property is transferred to spouse and minor child, the individual who has transferred the property, he will be considered as a deemed owner. So here even section 64 we can see where clubbing provisions will be applicable. Since individual is considered as a deemed owner, so whatever income that has been earned on that particular property, either in the name of spouse or minor child, that will be added or to be taxed in the hands of the individual who transfers the property. But there are exceptions to this rule. The first rule is with respect to a spouse where there is an agreement to live apart. Like husband and wife is there, either husband transfers or wife transfers to the husband or vice versa, whatever it is. It is for inadequate consideration. If there is no agreement to live apart between husband and wife, then who transfers? The transferor will be considered as the deemed owner. If there is an agreement to live apart, so there is an agreement between husband and wife and they have agreed to live apart. In that situation, the property is transferred, whether for adequate or inadequate consideration, then this deemed owner concept will not come. The transferee will become the owner of that particular property, and subsequently the next financial years or whatever it is from that year, the transferee will be considered as the actual owner. In case of transfer to a minor child, so it says minor child. So there is one exception where minor being a married daughter. So if the transfer is, if the assessee individual is transferring a property to his minor daughter who has been married, then that particular person is, the assessee is not considered as a deemed donor. Otherwise, he or she will be considered as the deemed donor. So here they talk about minor being a married daughter. They won't talk about minor being a married son. So if the property is transferred by an individual to the son, minor son, he is considered as a deemed donor. If it is transferred to a minor married son, then also he will be considered as a deemed donor. If it is transferred to the minor daughter, unmarried minor daughter, he is considered as a deemed donor. If it is transferred to the minor being a married daughter, then he will not be considered as a deemed donor. So this is two situations with exceptions where a person who is not legally the owner of a house property is considered as deemed donor under section 27. Next, we have another situation, owner of an impartible estate. So actually practically I have also not come across this impartible estate as such. There may be a situation where earlier the rulers would have given a particular property to a particular individual and they say that you cannot transfer this or you cannot sell this. And it has been that particular estate, it's one unit which is in the name of a particular individual, and he would have given it to so many people, but it says owner of an impartible estate. Even though he would have transferred a portion of that particular estate to various people, he is considered as a deemed donor, and in his name the income has to be charged under or calculated under the head income from house property. The annual value of impartible estate should be charged in the hands of the owner, who is the owner of the entire impartible estate. Then there is a situation, of course, this in southern regions we don't have this type of situation. Of course, in western region, northern region and eastern region we may have member of a cooperative society, company or other associations to whom a building or part thereof is allotted or leased under building scheme. So you people will understand better being in western region and other parts of India, because we don't have this one in southern region. So like this is a situation where a particular property or a flat, I should say, I was telling an example of some 20 flats, maybe we can take some 25 flats in a particular apartment as such, where it is constructed by a cooperative society or a company or other associations. So let us take an example of cooperative society. Let us say that there are 25 units in a particular apartment and it is owned by the cooperative society and they have membership. So 25 membership are there, and a person, any person who becomes a member of a cooperative society, of that particular cooperative society, he may be entitled or he may be allotted a particular unit in a particular house in that particular apartment asset. So there are 25 members of a cooperative society and there are 25 units in a particular apartment. Each member will be allotted one particular house property. The property may be in the name of cooperative society itself. So subsequently, if that particular member has to transfer that particular property, he will only transfer the membership to the buyer, and that particular buyer who gets the membership of that cooperative society, he will be entitled for that particular house property. So there is a deemed donor, the individual, the member who is a individual who is a member of a cooperative society, in the example what I gave, or if it is in the case of a company, if it is a company structure, shareholder of that particular company, who is entitled for a particular house property on becoming a member of a cooperative society or company, he will be considered as a deemed donor. Even though the property may be in the entire apartment may be in the hands of cooperative society or company, but the member of that particular company or cooperative society, he will be considered as a deemed donor, and income from house property will be charged in his hands, not in the hands of cooperative society or company. Then a person is considered a deemed donor in a situation where he retains possession of house property in case of part performance of a contract under section 53 of Transfer of Property Act 1882. So this is a situation where a person is transferring a property, a seller is there and a buyer is there. So seller is interested to transfer his property or sell his property to the buyer. There is an agreement to sell and you would have received all the considerations also, and all other formalities, whatever the conditions are there, it would have been fulfilled. It's only a part performance. One of the part performance may be registering that particular sale deed. So everything is over, and he has also given the possession, the seller has given possession to the buyer. So all those things have been completed. The only thing that is required is registration of property, the transferring of the title deeds under section 54 of the Transfer of Property Act. So if that has not happened, so it's only a part performance of the entire contract, then the buyer is considered as a deemed owner, even though in the registered this thing, the seller's name will be there as an owner legally, but as per this act, particularly 53A of the Transfer of Property Act, for fulfilling the part performance of a contract where the buyer has already taken possession of that particular property and started using that particular. The last one is in this deemed owner concept is in case of lease. So if a person, owner is giving a particular property on lease, not a lease which has been given for less than 1 year, usually the lease will be for 11 months, which will be renewed as such, but it is a long-term lease. Long-term lease means 269 UA says where the lease period is exceeding 12 months. 12 years, then it is considered as a long-term lease, and the lessee who is taking that particular property on lease, he will be considered as a deemed owner and not the lessor. So these are the situations where the owner, what we have understood, there is something called a deemed owner concept. These are all the situations under section 27 where he may not be a legal owner, but he is considered as a deemed owner, and in his hands, income from house property will be calculated. So computation of income from house property already explained, that is gross annual value we have to take. Then from gross annual value we have to reduce the municipal taxes paid. I have written here municipal taxes paid. It means only whatever actually paid in a previous year is allowed as a deduction from the gross annual value. So if municipal taxes is not paid in a particular previous year, we cannot claim that deduction. And if it is paid for more than a year, whatever has been actually paid, then that will be allowed as a deduction. So from gross annual value, when we reduce this municipal taxes, then we will get this net annual value. Two deductions I explained in section 24. 24A is 30% of net annual value, that is standard deduction. Then interest payable on housing loan. So interest payable on housing loan, if you deduct both these things, add these two, and you will claim deduction under section 24. Income from house property, you will get either income from house property or loss from. Discussed about types of house properties. So we have let out property, which is dealt under section 23 subsection 1. Then we have self-occupied property, which the section 23(2) subsection A deals with that. Then we have deemed to be self-occupied property, section 23(2)B deals with it. And finally, we have deemed to be let out property, section 23(4)B and section 23(1). So we have only these 4 types of properties which is subject to taxation under the head income from house property. We don't have like in between partly self-occupied and partly let out. That particular thing is not there. Already I explained in my opening remarks that even if the property is let out for one particular day in a previous year, financial year, that will be considered as let out property, and we don't have that bifurcation of partly let out and partly self-occupied. Either it can be let out or self-occupied. Now gross annual value as per section 23 subsection 1, how to determine the gross annual value in case of let out property. Of course, all of us are aware about this, but still I'll just take you through this. Section 23(1) subclause A talks about how to determine the gross annual value. Step 1 talks about fair rental value or municipal valuation. So in case of let out property, first we have to ascertain the fair rental value. So fair rental value means, as all of us are aware, it is a value or a rental value which a particular this particular property in that particular locality, similar locality, how much it can fetch. So if an assessee has got a house property and he has to calculate the fair rental value, maybe similar property in the same locality or in the same apartment, how much it is getting. So that will be considered as the fair rental value. Then we should compare this fair rental value with the municipal valuation, whichever is higher is the annual value in step 1. So the municipal valuation means for paying these municipal taxes, every municipal corporations or municipality, they will have a system of calculating the municipal valuation of a particular property based on which we have to pay the municipal taxes. So the fair rental value arrived or municipal valuation, whichever is higher, has to be considered as the annual value on step 1. Then compared with this, the whatever that value you get, that will be considered as a fair annual value after step 1. That needs to be compared with the standard rent. So the standard rent means in step 2, there is something called a standard rent. That also everywhere it may not be there. So where the property is subject to Rent Control Act, so there they may fix a standard rent. So whatever annual value we arrive at step 1, and if that particular property is subject to standard rent, so that needs to be compared with this. So whichever is lower is annual value. So in the sense that if there is a standard rent, the annual value that we arrive after step 2 should not exceed the standard rent. So whichever is lower means it should be maximum to the standard rent, and if this is less, annual value of step 1 is less, that will be there. So at any cost, after step 2, it cannot exceed the standard rent. Then the third step is, now assume that this particular property is let out. So we are receiving actual rent received or receivable. As I said, on accrual basis, this income is subject to tax from house property. So actual rent received or receivable has to be compared with the annual value of step 2. So annual value, whatever you get under step 2, this has to be compared, and whichever is higher is considered as gross annual value. So here only I am talking about gross annual value. Here I am only talking about annual value. So this will be after step 3. This will be the first line in the computation which I showed in the previous slide. The gross annual value will come. So there is another situation. Now this is a regular situation where an assessee has let out the property, and the property is there on this is for the last 12 months. So there is one more situation, that is step 4, where property is let and was vacant during previous year. So this is a situation where we can claim the vacancy allowance. Before this, let me explain this actual rent received or receivable. So in this, there is something called unrealized rent. So there may be something called unrealized rent, means the owner of the particular property is unable to recover rent from a tenant, and it is considered as unrealized rent. So wherever you have a situation of unrealized rent, that has to be deducted from actual rent received or receivable in both the situations. Here also I have written actual rent received or receivable. In both the situations, wherever actual rent received or receivable is there, if you have something called unrealized rent, that has to be deducted. So in the computation itself, you will deduct that from the actual rent received or received. Say for example, the house property has been let out for the past 12 months, and the tenant has given rent for 10 months and given the rent. So it is considered as unrealized rent. Unrealized rent. So there is a specific rule 4, which talks about which are all the situations where you can consider a particular situation as unrealized rent. The situation is the owner has tried his best to get realize the rent, but is unable to realize the rent, and the particular tenant has vacated the property, and the particular tenant is not occupying any other property belonging to the owner, and you would have taken all steps to take legal action about against that particular tenant. So all these situations, if you come across, then it is considered as a situation which warrants that the rent not received is considered as unrealized rent. So from actual rent received or receivable in both these situations, if there is unrealized rent, we have to remove that. So if say suppose here unrealized rent is there, you remove that and compare this with annual value as per step 2, whichever is higher is gross annual value. Now in step 4, I am talking about another situation where it is a vacant land, vacant property, vacancy allowance. So if the same situation, what I said in the example, a property has been let out in the previous year. For first 10 months, the tenant is there and he has also paid the rent. The next 2 months, the property is vacant. So when once if the property is vacant, so in case of step 4, situation arises when property is let and was vacant during previous year, then actual rent received or receivable or annual value of step 2, that is this step 2. If actual rent received is less, consider it as gross annual value. If you see in step 3, we will compare the result of step 2 and actual rent received or receivable, whichever is higher we will take. In this situation, if the property is vacant and you receive less actual rent, and assume that standard rent is or whatever, if standard rent is there it will come, or after step 2 something is there which is more, but because of vacancy, the property being vacant for 2 years, the actual rent received or receivable was less, then that will be considered as gross annual value. So in case of let out property, these are the 4 steps that we have to apply and arrive at the gross annual value. Only if it is if there is standard rent for a property, step 2 will be there. Otherwise, from step 1 only we will go either to step 3 or step 4. So if there is a vacancy, step 1 and step 4. If there is no vacancy, step 1 and 2 and 3. So if standard rent is there. So if standard rent is not there, 1 and 3 or 1 and 4. If standard rent is there, first 1 and 2, then either 1 and 2 and 3 or 1 and 2 or 4. There cannot be a situation where for a particular house property, all the 4 steps will be applicable. So that we should be clear in that. So all the 4 steps will not be applicable for any one particular house property as such. So these are the treatment of unrealized rent. When you will okay. With respect to vacancy allowance, let me give you one more issue here. So in case of vacancy allowance, so when a particular property will be eligible to claim vacancy allowance, this is very important, we have to understand. Only if the particular property or a unit is let out and subsequently it has become vacant, then only we can claim a vacancy allowance. Before the property being let out, if the property is not at all let out and it is vacant throughout the previous year, whether we can claim the vacancy allowance? The answer is no. We cannot claim vacancy allowance in a situation where that particular property was not at all let out. So the vacancy comes only when once the property is let. So if you see this, situation arises when property is let and was vacant. So only vacancy can come after the property is let. Before letting out the property, we cannot claim vacancy allowance. So the unrealized rent, as I said, conditions prescribed under Rule 4 is the tenancy is bona fide, the defaulting tenant has vacated or steps have been taken to vacate him, and he is not in the occupation of any other property assessee. The assessee has taken all steps to institute legal proceedings. Now coming to this self-occupied property, how to determine the annual value. Under section 23, subsection 2A talks about how to determine annual value. Annual value of self-occupied property is taken as nil and no deduction for municipal taxes paid is available. This already I have explained. So if it is a self-occupied property, always the annual value is taken as nil. So there is another situation, 23.2b, which talks about deemed to be self-occupied property. In deemed to be self-occupied property also, these two clauses are here. Annual value is taken as nil and no deduction for municipal taxes paid is available. What is the situation which warrants or determines a particular property is considered as deemed to be self-occupied property, that is DSOP. So this is a situation where owner of a particular property who is staying in a particular city, say suppose city A is staying, and he has moved to city B. So city A is staying and he is moved to city B, and city A is having a house property, and for the purpose of his employment, owing to his employment, business or profession, carried on at other place, that is city B. He is living this particular property and he is staying in city B, where he is not owning any property. So in city B he is not having any property, but in city A is having one property. Because of his employment, business or profession, he is supposed to shift to city B. Then city A property is considered as deemed to be self-occupied property. So this is a situation where a person assessee is residing in the other city where he is not owning a house property, and he has got a property in the other city and it is not let out during the previous year. So then that is considered as deemed to be self-occupied property. So when we understand this, the situation of deemed to be self-occupied property and self-occupied property in 23 subsection 2, then we have section 23 subsection 3. So these are some of the important points to determine a particular property is self-occupied or deemed to be self-occupied. So the annual value will be taken as nil if both these conditions are satisfied. So what are these conditions? Either it is a self-occupied property or deemed to be self-occupied property. The first one is the house or part of the house is actually not let out during whole or any part of the previous year. I was telling this, I think a couple of times I already said that it should not be let out for even a single day in a previous year. So whole or any part of the previous year. The house or part of the house is actually not let during whole or any part of the previous year. So then it will be considered as property self-occupied or deemed to be self-occupied, and no other benefit therefrom is derived by the owner. So the particular property, you should not derive any other benefit. So in the situation of deemed to be self-occupied property, I said there is one house of the assessee in city A and he is working in city B. Then due to his employment or business or profession, then that particular property in city A will be considered as deemed to be self-occupied, provided it is not let out during any part of the previous year and no other benefit therefrom is derived by the owner. So what do we understand by a benefit derived from a particular house property means? It doesn't mean that, say, suppose that particular assessee is staying in city B, and in city A his family is there, his spouse and children are there, or his parents are there. That is not construed as a benefit derived, but that particular property should not be let out during previous year. What is the benefit means? Property and raise any loans from the he should not raise any loans for that particular property. If he has raised loans for the purchase or construction, it is okay. If he is borrowing funds for some other purpose, pledging this particular property, then it is construed as particular benefit derived from this particular property as such. Sir, anything disturbance is there?
No, sir, no.
Okay, I can continue. So we have our chairman. I saw our chairman.
Yes, sir.
Yes, sir. Okay.
Yeah.
Then we will talk about this deemed to be let out property under section 23 subsection 4. So if assessee has 3 or more houses, which is as per section 23 subsection 2, that is either self-occupied or deemed to be self-occupied. So there is a amendment which says earlier it was only one house property. Now 2 house properties at the option of the assessee, he can use it as self-occupied property or deemed to be self-occupied property. The subsequent houses, 2 houses at the option of the assessee is treated as per section 23(2), that is annual value is nil. The remaining houses will be treated as let out property and annual value is calculated as per section 23(1)(a). So after 2 houses at the option of the assessee, the third houses and subsequent houses, if all of them are either self-occupied or deemed to be self-occupied, then the remaining houses will be considered as deemed to be let out property under section 23 subsection 4, and for that we have to calculate gross annual value under as per section 23 subsection A. So there may be a question where if it is considered as deemed to be let out property which is not been let out during the previous year, whether we can claim vacancy allowance. The answer is no. We cannot claim vacancy allowances for deemed to be let out property, and we have to apply that. That is fair rental value or municipal value, and if there is a standard rent, all those calculations. The actual rent received or receivable will not be there. The other parts, whatever is there, either fair rental value, municipal value, standard rent, if it is there, based on that we have to calculate and arrive at the gross annual value. Then other points with respect to 23 subsection 5, this is with respect to a person who is owning a building or land apportioned thereto. This usually happens in case of builders where they have constructed these apartments, and their business is to sell that particular property. They will construct and sell that particular property. Of course, all of us would have seen this practically in our practices. Because of this various reasons, there may be stock in trade. So suppose let me take an example. A particular assessee has constructed around 200 apartments, and his business is to construct the house property and sell that particular property. Maybe after getting the completion certificate, he started selling. He could sell around 100 to 150. Assume 150 house properties he has sold, the flats. There is a stock in trade of 50 properties, and due to pandemic he couldn't sell those 50. So whatever property is held as stock in trade is subject to tax. It is considered as deemed to be let out properties under section 23(4), and that will be subject to tax as deemed to be let out property under section 23 subsection 1. So property or any part of the property is not let during the whole or any part of the previous year. Of course, it's a stock in trade which is not used for letting out that particular property. It's idle. Then the annual value of such property is taken as nil for 2 years. So whether initially it will start, so there is one exception or some relief to these builders where they get the completion certificate. When they obtain a completion certificate, of course, after completion of that particular apartments where it is capable of it's a dwelling unit or it is capable of using it as a residential house property, then only you will get a completion certificate. So from the end of the financial year where you get the completion certificate, the next 2 years we need not bring this stock in trade as to be charged as income from house property. From the third year, that will be subject to taxation. So from third year onwards, property held as stock in trade is treated as deemed to be let out property, and the annual value is computed as per section 23(1) and is chargeable to tax. So here also, as I explained earlier, vacancy allowance can't be claimed because it was not let out at all. So there is no question of claiming vacancy allowance. So all the remaining stock in trade, say now in the example I said, so he has constructed 200 apartments or 200 flats, and 150 has been sold either before the completion you would have sold, or after completion within 2 years you would have sold. The third year there is a stock in trade of 50. So after getting that completion certificate from that financial year, next 2 financial years you would have sold 150 flats. The 50 is a stock in trade. So on that we have to calculate the income from house property as deemed to be let out property. When you have to determine this stock in trade, which point? So third year you are starting. So third year this stock in trade is subject to taxation. At what point of time you should take the stock in trade? So according to me, you should take the stock in trade on the last day of the financial year. So third year, end of the third year, that is end of the third year financial year, 31st March of that particular third year. So there you should determine what is the stock on hand. Say it is 50 in my example, what I am saying. That 50 will be subject to tax for that particular financial year. The fourth year ending, you would have sold another 10 flats. So the stock in trade will be 40. On that 40, we have to calculate the income from house property as deemed to be let out property. So till he exhausts all this stock in trade, it will be subject to taxation under the head income from house property. When he sells the property, the income will be charged to tax under the head income from business. But if he holds the property, it will be charged to tax under the head income from house property. Then deductions under section 24. There are two deductions. 24A talks about 30% of annual value. This is a standard deduction. This is available for let out property or deemed to be let out property. For self-occupied property and deemed to be self-occupied property, this deduction is not available. That is 30% of NAV is not available. Then comes this section 24B. So in case of let out property and deemed to be let out property, there is no limit prescribed for interest claim. So 24B, as I explained, it is interest payable on housing loan borrowed. So in case of let out property and deemed to be let out property, there are no limits prescribed for interest claim. In case of self-occupied property or deemed to be self-occupied property, it is either 30,000 or 2 lakhs as the case may be. So there are certain situations where the interest payment is restricted to 30,000. There are certain situations where interest payment can go up to 2 lakhs. So let us see what are the situations, how it has to be done. So interest of 30,000 will be allowed when the loan borrowed. There is no time period. Anytime the loan is borrowed, interest is allowable for up to 30,000. So what should be the purpose of loan? The purpose of loan can be repairs or renovation or reconstruction of a house property. And acquisition or construction is not applicable. Certificate of loan, whether they have to acquire certificate of loan for payment of interest of 30,000, it is not required. In case of this situation where loan is borrowed after 1/4/1999 and the purpose of loan is for acquisition or construction. If you see the purpose of loan here, it is only for repairs, renovation or reconstruction, which is limited to 30,000. In case of the loan borrowed for the purpose of acquisition or construction, then you can claim interest up to 2 lakhs. The other conditions is loan should be borrowed on or after 1/4/1999. Acquisition or construction. So purpose of loan, whether either for acquisition or construction, this has to complete within 5 years from the end of the financial year in which the loan was borrowed. So say assume 1/4/1999 that particular assessee has borrowed. End of the assessment year, that is 31st of March 2000, within 5 years, that is 31st March 2005, either he has to acquire or construct. If for whatever purpose he has taken, for acquisition or construction, then it has to be completed within 5 years. Then certificate of loan. To claim the interest up to 2 lakhs, there is a certificate required from the lender. So the person who has lent the loan, he has to give a certificate, and interest is also claimable on accrual basis. It's not that actual interest paid during the previous financial year is eligible for deduction under section 24 subsection B. Even the interest payable during the previous year is allowed as a deduction under section 24B, provided they get a certificate from the person who has lent the loan stating that this is the interest that has to be received for a particular financial year. Based on that, they can claim the deduction. Now coming to other aspects of interest under section 24B, there is something called a pre-construction period and pre-construction interest. First, let us understand what is this pre-construction period. So when we talk about pre-construction, it applies to construction of a property, not for acquisition of a property. But of course the wording says where property is acquired or constructed by borrowed capital. So you have taken a loan for acquisition or construction of a property. Then the period prior to previous year in which the house property is acquired or constructed. Usually the wordings is for acquisition or construction, but you will not get a loan from financial institutions until unless you identify a house property for purchase. For construction, of course, you can take a loan on a land and then you can start constructing. So whenever you have borrowed funds for construction of a property, and during the previous year, because the construction may go for beyond one financial year, it need not be only for one, means you take a loan and it's not that you will construct the property within that particular financial year. It may go to 2 or 3 financial years depending upon the size of that particular property or the construction of that particular property. Assume year 1 we have borrowed a capital, the assessee has taken a loan, and year 3 he has constructed, he has completed the construction of that particular property. So what is pre-construction period? The period prior to previous year in which the house property is acquired or constructed. So in year 3, this particular property was completed or constructed. Previous year prior to this year is year 1 and year 2, where he has borrowed the proper means funds and is paying the interest, but the construction is not completed. Construction is completed only in year 3. So year 1 and year 2 is considered as pre-construction period. So when once the financial institutions have given you the loan, it doesn't mean that you need not pay the interest. So you may have to pay the interest on that particular property or loan that has been taken. So whatever the interest that we pay in year 1 and year 2 for that pre-construction period is considered as pre-construction interest. So the interest paid during the pre-construction period is considered as pre-construction interest. And in third year, where the property is completed, either acquisition or construction, fourth year, that is assessment year for third previous year, we are charging that particular property income to tax. So there we can claim deductions under section 24B, that as interest paid. So how to claim this pre-construction interest? So first we have to calculate the pre-construction period and arrive the interest amount that has been paid during this pre-construction period. And if we have claimed this interest under any other provisions of the Income Tax Act, then that will not be eligible. So whatever is not claimed in year 1 and year 2, that will be considered as pre-construction interest. Then that has to be divided in 5 equal installments. So that has to be divided into 5 equal installments, that is 1/5. So that particular interest plus the interest that you pay in year 3 for the year 3, total should be, we should claim in year 4 and the assessment year. So this 1/5 of the pre-construction interest has to be claimed starting from the year in the previous year in which the particular construction is completed, and 4 subsequent assessment years or subsequent years. The next 4 years we have to calculate or consider this pre-construction interest along with the current year's interest. We have to claim that particular deduction under section 24B. When we add current year's interest plus pre-construction interest, the total should not exceed the limits the assessee is eligible for. Say if he is eligible for 2 lakhs, both put together it should not exceed the 2 lakhs or 30,000, wherever it comes. But usually 30,000 should not come because 30,000 is not eligible for construction of a house property or acquisition of a property. So though both this income put together, both this interest put together, it should not exceed that 2 lakhs limit. Or if it is a let out property, there is no limit. If it is a self-occupied or deemed to be self-occupied property, it is subject to that 2 lakhs limit. New loan. So any loan taken to repay the existing housing loan. Say suppose assessee has taken a particular loan from a particular bank, and subsequently after 2-3 years he feels that there is another bank which will take over this loan at a reduced rate of interest, then there will be shifting of that particular loan. So a new bankers or new financial institutions will come and take over the existing loan of existing housing loan for a reduced rate of interest. So that is also that is considered as a new loan, and whatever interest we pay for the new loan will also be eligible for deduction under section 24B. That will also be considered as the what you call this amount borrowed for the purpose of acquisition or construction of house property. Then we have this composite rent, letting out of building and other assets, maybe plant and machinery, furniture, etc. So this is with case of a letting out of a business asset. So there is a situation where an assessee who is owning a particular building and also is furniture or plant and machinery, he wants to let out this particular thing where he can separable letting out of building and letting out of other assets. If he can determine that these things can be separated. So a person is, an assessee is letting out both the building and other assets. Other assets may be plant and machinery, furniture, etc. And if he can draw a separate thing. So what is the rent for the building and what is the rent for plant and machinery furniture, if you can bifurcate separately, then letting out of building will be considered as income from house property, and letting out of other assets, that is plant and machinery and furniture, it is considered as income from business or profession or income from other sources. So this is with respect to a business unit where it is inseparable. So you cannot bifurcate between plant and machinery, furniture, rent and building. Or there may be a situation where the owner of that particular building says, I am not interested to give building on rent. I am only giving plant and machinery and furniture. And it is not separable. Inseparable means you cannot even remove that plant and machinery from that building. And he says, you take plant and machinery and furniture on rent. It is incidental. Building is also incidental to you. In such situations, the income is subject to tax under the head income from business or profession or income from other sources. So this we also have this apartments where you will collect the rent, and also you will collect something for other services, that is maintenance charges or some other watch and ward, whatever that charges is there, you may collect that composite rent both for the building plus other maintenance charges. In those cases, you can bifurcate that, and whenever whatever the rent you collect is considered as income from house property, the other service charges which you collect is considered as income from other sources. Then amounts not deductible, I think this already I have explained. If any interest is payable outside India in respect of which there is no person in India who may be treated as an agent under section 163. So whenever you have borrowed amounts from a non-resident and you are supposed to pay interest on that housing loan, which is deductible under section 24 subsection B, and if there is no person in India who is acting as an agent of the non-resident, you are making a payment to him and you are not deducted TDS under that section 195, then we cannot claim the deduction under section 24 subsection B. Then we have 25 years special provisions for arrears of rent and unrealized rent received subsequently. So arrears of rent I explained earlier in my opening remarks, or unrealized rent also I have explained. So say there is a situation where after a certain years the tenant would have agreed and you would have paid this arrears of rent, or the situation where there was an unrealized rent because of the efforts of the owner, the tenant would have paid, you would have realized some rent from the tenant subsequently, and that will be subject to tax under the head income from house property. During the year when he receives arrears of rent or unrealized rent, or even as I said, even the regular rent also, the assessee, whether the assessee is the owner of the property or not in that financial year. So maybe you would have sold the property after 3 or 4 years, you would have received some arrears of rent or unrealized rent has been realized. Even though he may not be the owner of that property, he will be considered as owner of that particular property, because as I said, he has a right to receive that rent. So he may not be the owner of the particular property, but he has a right to receive that rent. He has received. In that situation, it will be charged to tax on the head income from house property. Of course, since he wouldn't have paid any municipal tax for the previous year where he is not the owner, so we cannot claim that. Then 30% of NAV is allowed under section 24B. That is 30% of standard rent. On arrears of rent or the unrealized rent, he can claim the deductions from that. Then property owned by co-owners, already I have explained. If you can determine the shares of the co-owners, then it will be considered as an individual. It is definite and ascertainable. They will be considered as individual owners, and it will be they will be independently assessed or independently subject to taxation or other income from house property. Then there may be a situation where husband and wife being co-owners, their shares are determinate, and they may be paying more than 2 lakhs as interest on borrowed funds. So once you bifurcate that based on their proportions, each one of them will be eligible to claim the 2 lakhs. If they have paid more than 4 lakhs, and if they have 50, whatever the percentage is, they assume 50%, if they have paid 4 lakhs and above, each one of them can claim 2 lakhs each. So all the deduction, that 30% of NAV, everything they can do, and with their other income, this also will be added and they can pay the taxes. So if you can't, individual share is not ascertainable, then the income is charged as association of persons. Set off and carry forward of losses. Intra-head set off, section 70 talks about that. Where the property has been let out, loss from one house property can be set off against income from another house property, no limit. So this is intra-head set off, where assuming that assessee has got more than one house property, and one house property is let out, one is self-occupied, whatever is there. So all those things you can set off, like or if you have various house properties which is let out. So all those income and independently will calculate the income and loss from each and every house property. Intra-head, everything can be set off. There is no limit prescribed under section 70. Intra-head set off. Under the head income from house property, there are 5 properties. One is self-occupied, one is deemed to be self-occupied, one is let out, another one is also let out, something like that. Another third one is also let out. So like this, if you do something, whatever this thing losses are there, intra-head it can be set off. Then inter-head set off, section 71 subsection 3a talks about inter-head set off. The limit of set off of loss from house property against other heads of income is rupees 2 lakhs. So we have other 4 heads of income, that is income from salary, income from business, other sources, and capital gains. So whenever wherever this house property loss can be adjusted with other heads of income, it is restricted to rupees 2 lakhs. And a particular financial year or a particular assessment year, when you calculate the interest paid on a particular property up to 2 lakhs will be eligible for claiming that is current year losses. If there is a loss of say 2.5 lakhs, only 2 lakhs can be adjusted, 50,000 has to be carried forward. So there is another section, carry forward and set off of losses, section 71B, which talks about losses that can be carried forward and set off in subsequent years. And the limit is 8 assessment years, subject to a limit of 8 assessment years against income from house property only. So we know that whenever it is carry forward of losses and when we are supposed to set it off, it has to be set off against the same type of income, the same nature of income. So in this case, the carried forward loss can be set off against income from house property only. There are certain deductions under chapter 6A, section 80C, which allows an assessee to claim the tax benefits on the repayment of principal of housing loan. So repayment of the principal. So there are two elements whenever you borrow funds. One is we in the EMI when we see there will be two elements. One is making payment towards principal of loan, and the other element is making payment towards interest on loan. So the principal can be claimed under section 80C up to the subject to the overall limit of 1,50,000 per annum. There are two sections, very small deductions I should say. Section 80EE. So this is to encourage small assessees to own their house property. As initial in the opening remarks, Chandrakant sir was telling that every individual or every person would like to own his own house property. Just to encourage that, the government would have has come out with this section. This section 80EE, deduction in respect of interest on loan taken for residential house property. So who is eligible? Individual who has borrowed loan from either financial institution or a housing finance company, and the deduction not exceeding rupees 50,000 for assessment year 17-18 and subsequent years. So there are certain, it started from assessment year 17-18. So the deduction towards interest paid is 50,000, and this is over and above that 2 lakhs, which is eligible under section 24B. There are certain conditions. Loan for this particular house property should be sanctioned during the financial year 16-17. So only that particular financial year, if the loan has been borrowed, then they will be eligible. Loan amount does not exceed 35 lakhs. So the total loan amount should not exceed 35 lakhs. It should be less than that. Value of residential property does not exceed 50 lakhs. So when once you take a loan of 35 lakhs, and the value of the property should not be more than 50 lakhs, and assessee does not own any residential property on the date of sanction of loan. On the date of sanction, you should not own any particular house property. So this should be the first house property by which he is purchasing. Then the other conditions. So whenever you claim deduction under section 80EE, you cannot claim the same amount of interest under any other provision. As an example, like 24B, if he has paid interest of say more than 2 lakhs, 2 lakhs plus 50,000, say assuming he has paid 2 lakhs 75,000 and he is eligible for this under 80EE, he can claim 50,000 under 80EE and balance up to 2 lakhs under 24B. So the same amount he cannot claim 2 times. Say if he has only paid, assessee has paid only 2 lakhs, then we cannot say 50,000 I claim in 80EE and 2 lakhs I will claim in 24B. There you can only claim 1,50,000. Then other section is there 80EEA. So that was only for 1 year. That 80EE was only for 1 year. So this is the new section which has come, deduction in respect of interest on loan taken for certain house property. So eligibility, the person who is not eligible to claim deduction under section 80EE. So it is only for individual, and if he is eligible under 80EE, then he will not be eligible for 80EA. So those individuals who are not eligible for 80EE only will be eligible for 80EA. And the deduction here is 1,50,000. There it was 50,000. Here it is 1,50,000 from assessment year 2021 and subsequent years. The assessment years. So here 1,50,000 we can claim under section 80EEA and also 2 lakhs under section 24B, provided they have paid total interest or payable is more than 3.5 lakhs, 3.5 lakhs and above. Total the conditions, there we had 4 conditions, here we have only 3 conditions. The loan sanctioned between the period 1/4/2019 to 31/3/2022. It was up to 31/3/2021, now it has been extended. So any loan borrowed, sanctioned between this period, that is 2019 to 2020-22, and stamp duty value of property does not exceed 45 lakhs. So there in 80EE, there was a condition that value of the property should not exceed 50 lakhs. Here, and there was a other limit of loan amount, that is 35 lakhs. Here we don't have any loan amount limit, but it only says stamp duty value of property does not exceed 45 lakhs. So the market value may be 60 lakhs also, but stamp duty value should not exceed 45 lakhs. The loan should have been sanctioned between this period, and this should be the first house because he should not own any residential property on the date of sanction of loan. Then other conditions similar to that. So whatever interest you claim under, whatever deduction you claim under section 80EEA will not be eligible for claiming as deduction or allowance under any other provision of the Income Tax Act. Then TDS on income from house property, there are 2 sections, 194(1) and 194(IB). So here just I have taken that who is the payer. So payer may be any person under 194I, and in case of section 194IB, it should be either individual or HUF. Payee is any resident in India. Of course, for non-resident, section 195 will apply. Type of payment, rent for building or land apportioned thereto. Here rent for land or building or both for a month or part of a month. Time of deduction, like regular sections. Credit to account or payment in cash, whichever is less. Here also credit or payment, whichever is earlier, whichever is earlier, not whichever is less. So credit of rent for the last month of previous year or last month of tenancy if property vacated during the year to the account of payee. So here this 194 1B, one thing we have to see, credit of rent for the last month of previous year or last month of tenancy if property vacated during the year to the account of payee, or payment in any other mode, whichever is earlier. So suppose there is a agreement to pay the rent only at the end of the year, every year, or at the conclusion of the tenancy, last month of tenancy, then TDS provision will not apply on payment basis, because if you are not paid any rent, it's only credit of rent for the last month of previous year or last month of tenancy. Only if you make the payment, then that earlier will be coming, or if you are crediting only at the last month of the previous year, then TDS has to be deducted at the last month of the previous year or the conclusion of the tenancy. The TDS rate in this case is 10%, and in this case it will be 5%. The limit under 194I, as all of us are aware, it's more than 2.4 lakhs, and this is 2,40,000 per annum. This is more than 50,000 per month. So I think that we have just missed out this. This is per annum 2,40,000. and this is per month, more than 50,000 per month. Applicability, who has to deduct TDS under 194I if their turnover from business in the previous year is more than 1 crore, or if they are getting receipts from profession if it is more than 50 lakhs in the previous year. In under 194 IB, this is a situation where they are not subject to tax audit in immediately preceding financial year. So they should not be subject to tax audit. There are two situations where they will not be subject to tax audit. One is they don't have income from business or profession. The second situation, they have income from business or profession, but it is within very much lesser than the limits as specified for tax audit. So in those situations, this section 194 IB will be applicable. When you have to deduct TDS under section 194I, a person has to obtain TAN S for 194I. For 194IB, the TAN is not required. There's one more thing in this 194IB. If you're making, say suppose the deduction rate is 5%. And it is not paid. Every month you are not paying the rent, so only at the end of the year there is an agreement that end of the year you make the payment. So at the last month of the previous year it will be credited for 1 year. So assume that it is 75,000 per month into 12, it comes to 9 lakhs. On that we have to pay 5%, which comes to 45,000. So the last month, once you are making the payment, you have to deduct that 45,000 and make the TDS. So suppose there is a situation where you have to deduct TDS, which is more than the monthly rental of the last month, then it should be restricted to the particular rent that has to be paid in that particular month. So it cannot be more than the rent payable for a particular month, so it should be restricted to that. Sir, now it's 8. Can I take some of the issues, or how is it, sir? The basic provisions has been completed.
Yeah.
Chandrakant is there? Chandrakant,
Yes,
sir?
Yes, sir.
Hello?
How much time you require, sir, for issues?
Sir, it's not audible. You have to... Hello, Chandrakant, sir. You have to
Yeah.
unmute yourself.
You can't hear me? I'm unmuted, sir.
No. Now it is 8 o'clock. Shall I just take another 10-15 minutes for issues? Whatever
Yes,
I
sir.
can
You can
do.
take up some important issues, sir.
No problem. Okay. Anyway, I can run through fast. So some of the issues that is under section 22. Owner of structure is liable to tax even if he is not owner of the land. I think already I explained that. There may be two owners. One is for a land and one is for a building. So in this under section 22, the chargeability is applicable to owner of a structure and not owner of the land as such. Capacity to let out or power to receive rent is not relevant. So we cannot determine whether that particular owner has capacity to let out or power to receive rent is not relevant. If he is a owner and if he has let out that particular property, it is subject to chargeability under section 22. Property owned by the firm. So if the property is owned by the firm, and the firm only will be considered as the assessee and not the partners. So there may be a situation where property is owned by the firm and the partner is also there where they are doing some business of the particular firm. So if the property is owned by the firm, the taxability will go only in the hands of the firm and not in the hands of the partners, and partners also cannot claim any deduction or exemption. Where club provides lodging to its members, there is no element of letting. So this is not. So one more thing we have to understand in case of charging particular income as income from house property is there should be continuity in the letting out of that particular property. So there should be a tenancy. There's a ownership and tenancy relationship should be there. If there is no owner and tenant relationship, then it cannot be considered as the property has been let out. So this is a situation where club provides lodging to its members, maybe for 1 day, 2 days, something like that. So there is no element of letting, so that is not considered as income from house property. It will be considered as income from business or other sources. Where letting out is not organized activity of assessee. So this is also a situation where the assessee is not organized, or it is his main business is not letting it out. So in those cases also, it is not considered as income from house property. Sometimes it will be considered as income from business. Where letting out of business is part of business operations. So here also there are certain case laws which says it is income from business. Certain situations where it says it is considered as income from house property. So case to case basis, we have to see whether a particular operations is considered as chargeable to tax under the head income from house property or income from business or other sources. Income from paying guest establishment is business income. So we know that a lot of paying guests will be there where if it is established, it is considered as business income. Income from commercial complexes, even though it is a commercial complexes, since it is a building, that income is considered as income from house property. Unsold portion of building in case of builders, section 23, subsection 5, I have already explained, it is considered as income from house property. Income from lease of building for limited period is business income. So if it is there is a lease of a building for very limited periods, then it is considered as business income. So it is not continuous lease, so it's only for a temporary phase, then it will be considered as business income. Income from ancillary services as well as income from other sources, I already explained about that composite rent. Partner is not eligible for exemption when the property owned by him is used by firm. So when particular partner has let this particular property, he is the owner of a particular property. He has let it out to the firm either on rent or no rent, and the firm is using that particular property for the business, for the purpose of business. In that situation, partner saying that he is a actual owner of that particular property, he cannot claim relief under section 22, saying that I am doing business because I am one of the partner of the firm. Only firm can claim that exemption. In the hands of the partner, we have to calculate. We have to consider it as deemed to be let out property, and as per let out property provision, section 23, subsection 1, we have to calculate all the fair rental value, and he will be subject to taxation. 3. The property despair as annual value. So it is not we need not calculate what we call this annual value will not be determined based on the structure or the condition of a house property. If the house property is there, which is a dwelling unit which can be used as a house property, we have to calculate the annual value. Interest-free security deposit cannot be added. So usually in case of leasehold properties, then we will take a security deposit. So here there will be a situation where we take 10 months rent as security deposit. On that we cannot calculate interest-free security deposit and take it as income from that is not possible. Then interest on refundable advance deposit also cannot be included. Then vacancy allowance for third and subsequent house property, already I have explained. In case of more than owning more than 3 houses, which is all the houses are self-occupied or deemed to be self-occupied. At the option of the assessee, few houses, 2 houses can be considered as self-occupied, remaining has to be considered as deemed to be let out. There, vacancy allowance cannot be claimed. Where property is let out to employer and got re-allotted, benefit of self-occupation is not available. So there is something called self-leasing arrangement between an employee and the employer. The employee being a owner of a particular house property, he will lease that particular property to the employer, and subsequently employer will allot that particular property, and only that perquisite will be calculated as rent-free furnished accommodation or something like that. So in those cases where it has been leased out to the employer and again it has been re-allotted, the employee cannot claim that as a self-occupied house property, even though he is occupying that particular house property, but he has given that on lease to the employer, so he cannot claim it as self-occupied property. Whatever the lease charges he receives from the employer will be considered as the rent received, and accordingly it will be considered as a let out property, and other calculations will be done. The firm cannot get benefit of self-occupation. So only because the firm is not a natural person, only partners are natural persons. So firm cannot get benefit of self-occupation. Deduction not specifically provided for are not admissible. So deductions are specified under section 24 A and B. So whatever is not specified under section 24, we cannot claim. Of course, as I said, we can claim that unrealized rent deduction and vacancy allowance only can be claimed. Other than that, 24 specifically gives only 2 deductions. Beyond that, we cannot claim anything else. Deduction is separately allowable to each co-owner. This also I explained in case of co-ownership where the shares are determined. So you can compute based on their share of income, and deductions can be allowed separately for each co-owner. Choose with respect to section 24, relationship of borrower-lender must exist. So the relationship should be there as a borrower and lender. So then only we can claim deductions under the section 24. If interest has fallen due for payment, it cannot be deducted even if not paid. Sorry, it can be deducted even if not paid. So this is what I said, on accrual basis interest is claimed, not like municipal taxes where it has to be claimed only on payment basis. Interest can be claimed even on accrual basis. So if not paid but payable, that also will be subject to deduction under section 24. Interest on overdue interest is not deductible. So if you take an interest, borrowed the funds, not repaid that amount, there is interest on interest. Interest on interest is not deductible. Then interest on invested in properties owned by wife or minor children is deductible. So we saw
आम्ही
the
लगेच यायला निघालो होतो आई इथे येणार म्हटल्यावर
so
पण
where
गधड कुठे गेले तर फिरायला आणि सगळा फोन लागत
sir, you
होता.
have to mute yourself. Tale sir, you have to mute yourself. Interest on borrowed funds invested in properties owned by wife or minor children is also deductible. Then unpaid purchase price can be treated as borrowed capital. So if there is a transaction between two persons, a seller and a buyer, and buyer has not paid full consideration, so there may be a part consideration which is not being paid, and there is an agreement between a seller and buyer that can be paid in installments subsequently, and seller may also charge certain interest on that particular unpaid consideration. So that is also can be treated as borrowed capital, and with other conditions applicable, getting a certificate and all, he can claim that deduction, interest paid on that particular loan as deduction under section 24 subsection B. Interest paid by builder for delay in delivery of flat is not deductible. So there is an agreement between buyers and builder that within next 3 years or 4 years I'll complete the construction. If I'm not completing the construction after 4 years, whatever the delay, we will be paying you interest. So when once that has been done, the builder cannot claim that interest as interest allowable under section 24 subsection B. If he can claim under any other sections under business, he can claim, but under income from house property, he cannot claim. So these are some of the issues I thought I will just bring before you after taking you through the provisions of income from house property. As I said earlier, all these, most of the things we are aware, just it's brushing up of our memories, because this month and next month we'll be filing a lot of income, a lot of returns with income from house property. So this is what I could share with you. Once again, I thank each and every one of you who are there listening to my lecture from past 2 hours or almost 1 hour 45 minutes. Also thank DTC, and the chairman is there. I thank you all I thank you, chairman, for giving me this opportunity. And
Yeah, thank you.
Over to you, sir.
Yeah.
Can you just remove the PPT?
Yes, sir. I will just stop sharing.
Yeah, thank you, sir, for your presentation. But before we go ahead, I would like to welcome our own CCM, CA Chandrasekhar Chitrai sir, who is also the chairman of the Direct Tax Committee. If you have to say a few words here at this moment, sir, it's your time.
Yeah, it was a wonderful lecture. I could not join fully because I was also engaged in some lecture at a branch. Only a couple of points, I don't know whether they were covered. If you look at section 80 IBA, subsection 1A talks that where the gross total income of an assessee includes profits and gains derived from the business of developing and letting out of house property, there's one additional deduction available. So that also one can
Okay.
think of as far as house property is concerned. And in couple of cases, a unique aspect has been observed. What happens typically, you let out a property at say 50,000 rupees per month rent, and then society charges you annual maintenance charges of some 1,20,000 or whatever. At times, people believe that okay, if the rent is 6 lakh rupees, maybe after deducting municipal taxes, whatever 30% we can claim is the only deduction available. But we have certain tribunal judgments where they say that whatever society charges you pay is for a maintenance, but is for a maintenance of the society. So maybe common roads, staircases, etc. can be maintained out of that particular contribution and not the internal part of the house property. So this particular society contribution should be reduced from the gross annual rent, and then the net annual rent should be ascertained. On balance, you can claim again 30% this particular deduction for repairs, etc. And the case in question, I always used to remember because the litigant is Sharmila Tagore versus Joint Commissioner of Income Tax. It is reported in 93 TTZ Mumbai at page 483, and it is followed in so many cases. And one case subsequently, Saif Ali Khan versus ITO. So in these two cases, this particular judgment was given. So one can consider that also. That will give some more relief. But we thought it that okay, income from house property generally comes in almost every case, be it salaried employee, be it a businessman. In India, there is tendency of owning house property is substantial. So this particular head, income from house property, appears in each and every income tax return. So it was necessary to have in-depth analysis of this particular head of income. And I'm sure that Kota has done justice to this discussion. Are there any queries on this, what you say,
Yes,
chat
sir.
box?
Yeah,
If
yeah,
there
there are
are
a lot.
queries, you can ask because otherwise to get hold of expert is very difficult.
There are around at the moment there are 145 queries, sir.
Oh,
Been
so
raised
maybe
by the
what we can do, we will compile those queries and publish one FAQs on income from house property. I think that would be giving justice
yes,
to all those queries. But if
And this
there are important one or two queries, maybe you can ask before we conclude.
yes, sir. Okay,
Chandrakant sir, how many attended? Any numbers?
sir. That Ajay will be able to tell you. I
Okay.
cannot view that.
Okay.
But queries are 145,
Sir,
sir.
more than 1700 viewers are
Okay.
there.
Okay. Thank
Okay.
you. Yes, sir. One or two queries. Anyway, I have the cushion of our chairman who can talk about
Yes,
case
sir.
laws. I can only talk about law more. Sir. Yes, sir.
Mm-hmm. Yeah, just I'm going through the queries which are little critical, which can be asked.
Okay.
No, by the time he takes out queries, I think we will publish this FAQs on house property. So variety of queries can be taken care of, and that would be a
See,
book
what
handy
has
for all.
happened is most of the queries are very common, sir, which you have taken care
Okay,
of.
okay.
I think maybe, the in a sentence we can give those answers. Most of
Okay,
the
then
queries,
you can pass on those queries to them and maybe answers. If the queries are not covered in the lecture, then we will try to disseminate them by DTC
yes, sir,
website.
that would be better rather
Okay.
than putting time. So, friends, at this end, I would like to first thank our speaker for the today's session, Kota Srinivas sir. Thank you, sir, for taking out your valuable time and explaining the provisions of income from house property in detail. And it was much more in detail than what you said in the beginning that it is a small topic, but the way you started off, it seems to be a very long topic, sir. And
Yeah,
the way the way
in
you have
income
gone in depth.
in income
Yes,
tax
sir.
small point in income tax small point requires detailed attention.
Yes, sir. And that is what the justice you have given. You have only made aware that it is a small topic, but you ensure that it is not that small to understand. So with this, I would also like to thank DTC for organizing this lecture, and we have Chitre sir who has joined in the end to us. I would like to also thank him. for organizing such a wonderful webinar for all of us, and all the committee members of DTC and the technical team who has made all these arrangements for all of us to ensure that this broadcast is coming to us, or this webinar is coming to us in uninterrupted way. So I thank all of them, and in the end I would like to also thank all the participants who have joined this webinar and has taken out time and has taken the advantage of such a learned faculty and have heard them once again. Though we have learned this topic, but again we have rebrushed, and again we have enriched our knowledge by once again listening to such a learned person. With this, I would like to thank all of you, and I would like to say good night. Be safe and keep yourself in a healthy this thing, because of the difficult times that we are into. With this, once again, thank you very much, and good night.
Thank you, Anand also.
Thank you. Good night. Good night, Kota. Good night, all of you.
Good night.
Thank you.
Good night.
Okay.